Hey traders, Rocky here. Let's get an audio and video check in. Just want to make sure you can hear me and see my charts. You guys got Google on the brain? What a move, huh? I'm like an after hours $60 sell off to get your blood going. Fire when ready, RH. I like that. Yeah, it was fun watching John there. Pick those puts up and then put them back down. Okay, so we're going to just get started here in just a minute. For those of you who are not aware, we're doing a talk on the global risk environment, taking a look at not just currencies, but, interestingly enough, we had an ECB event today. I know it's kind of hard to remember that when Google's falling out of bed, but we're going to talk about the risk environment. We can even talk about the open. Sandy says, I'm not aware. How cool is this? Oh, there you go. I'm glad. Plenty of more coolness to come. Hot potato. You guys are just, you guys punch drunk from a whole day of this? All right, let's do it. So I'm going to take you around a few of my positions before you get started, just to get a feel for where I have exposure. Of course, as always, if you guys have any questions, type them in. We're going to focus mainly on actually some global equities markets. We're going to talk a little bit about the DAX today, Chinese large caps. We'll talk about the Dow, and we'll definitely talk about the NAS here. When you have a stock like Google, what is Google? About 9.5%, the weighting in the Dow, in the NAS. We'll take a peek at that. That's certainly going to affect the open early on. All right, so we're going to talk a bit about Brexit, today's ECB, the Bank of Japan, and the yen. I'll make sure that I give you guys some of the ETFs for those of you that don't trade the currency futures or spot market. I'll give you guys some alternatives to these setups. The yen, you bet, Celeste. Absolutely, we'll talk about that. With a risk off in the morning, that's absolutely going to be something we'll watch in the after hours. At least it's after hours for you guys, but we're just getting started in terms of the fresh trading day with the Asian Open here in about 2.5 hours. So Sandy says, just bought a great book, The New Case for Gold. Been thinking about Aussie dollar as a hedge against the US dollar. Just curious. You bet. We'll talk about that. In fact, I'll put it in perspective a little bit in terms of what's happening with gold, the current central bank rates. All right, it's good stuff. All right, let's go. Facebook and smoked. Oh yeah, let me take a look at Facebook. I actually own some Facebook, so. Oh, look at that. Huh, I was watching PayPal. I own a little bit of PayPal too. Now, a lot of what I do, I'm actually sitting here with a friend of mine, and, we're watching this sell-off in Google, and her question was to me, is this an opportunity to buy? And I said, it depends on where you're looking for the opportunity, weekly versus daily timeframes. And whenever we're talking about central banks, currencies, interest rates, to me, the better place to find the psychological clarity and then also the technical clarity are those longer term timeframes for sure. Amazon getting smoked too. I gotta tell you, I see these kind of sell-offs. I see these kind of corrections. To your point, Neil. Yeah, and I look for where the trending clarity is. I don't know that Amazon gets my attention longer term, but all right, let's just get to some of these central bank issues, and then we'll talk about the open tomorrow, and we could definitely circle back to what some of these tech names are going to do, and then also relatedly what the yen could do as we see maybe some early risk aversion. Okay, so I want to start off with a look at the euro here. How many of you are looking at the euro or the US dollar in terms of not only what the FOMC is going to do, but what the ECB and Mario Draghi were doing? How many of you caught that? Central bank rates and central bank events. Teresa says, yep, absolutely. We have to watch these things. Simon, Euro, absolutely. And the reason that we watch these things is even if you're in the equities markets, I want you to remember that it's like dropping a pebble in a pond. I mean, the reverberations are 360. You got to think about what happens when a central bank has decided that they're going to keep money cheap and flowing, and where that money, that cheap money, is going to go seeking yield. Where does that land? And for the most part, equities markets around the globe continue to benefit from two things. Number one, the only savings account anybody in Europe, including Switzerland, SNB, the ECB, and the BOJ have all said, you know what? Savings accounts, not going to happen here. If you want a savings account, you're going to end up in gold. So, Sandy, were you the one that had the question about gold? We can talk about that a little bit later on. Before you automatically think it's an Aussie play, though, I'll show you a couple things to consider before you put that trade on. Let's see. Steve says, I see the drop in IBM. We'll talk about that. Yeah, do me a favor. The last part, we'll be together here for about an hour. So towards the latter end of our convo, I'll make sure I talk about some of these heavier weighted stocks, what we see in the yen, and what we could see in terms of the open tomorrow, because I'll be interested in the open, but I'm also going to give you some other places to consider where the opportunities may be if you want to think about not just equities, but actually playing the futures, the index futures, ES, YM, and Q, and some of the coordinating commodity dollars, like Sandy mentioned with the Aussie. Absolutely. And you know what's interesting? I love this, that in a weird way, I'm thinking, oh man, there were Google earnings today, and we're going to be talking about central banks and the ECB. But you know what? It all ties together. Steve, yeah, it all ties together. And this is where I'm hoping to kind of weave this, where you see it's something I love to call one mind, many markets. What are all the connective threads? How can I take an idea, a theme, right? What's the theme? Risk on versus risk off. What is Google going to do to the yen? What's it going to do to the indexes? So we can take that theme and see all the different places it lands us. We've got a lot of opportunity. So I'll try to keep up with the comments here. Okay. And we'll just take it from there. All right, so first of all, ECB. Let's run on over to the euro. Euro was actually a lot of fun this morning because initially I was thinking to myself, could we see another one of those famous Mario Draghi risk-on spikes? Because when we take a look at these wicks in the euro, let's go back just a little bit. We take a look at some of these wicks in the euro. Some of these we've got to give Mario Draghi a lot of credit for. In other words, I'm talking about these two wicks right here. Those are ECB wicks, meaning that when Mario Draghi came out, said he's going to be accommodative, said he's going to keep money cheap and flowing in Europe, that helped put a low in our market, in the US market, in the Dow. Now, the other wick over here, some of you might remember from August, we're going back down memory lane here a bit, but I think this is relevant to the impact these central bank decisions can have on the equity side of things. Take a look at the Dow here. This is the China yuan devaluation. Now, this isn't just on the Dow. We were talking about Facebook a moment ago. Take a look at that wick. Same day, same reason. Heck, I was actually looking at grains today. You could even find that wick on corn. So when you look at the way in which some of these central bank events, again, think about dropping a pebble in a pond. Very little can hide from these major decisions. Second largest economy on the planet. You bet it's going to have an impact. When the euro and Mario Draghi take center stage, again, we've seen how an accommodative ECB can help risk on, can help us consider, well, is this a good opportunity to start getting long again in equities? Now, we're going to juxtapose two different things. Mario Draghi certainly didn't. Let me give you the timing on this really quickly. The market was already selling off after Mario Draghi's press conference. He wasn't nearly as dovish, I believe, as some traders would want. Am I going to say that the downtrend on the Dow here, that's the chart in the lower left-hand corner, let me blow it up here. Am I going to say this is Mario Draghi? No, I'm not going to just blame it on him, but You know what? Let's step out for a moment and look at 8:30 because that's when the press conference started. I think he went on for about 45 minutes to an hour. So there's 9:30. You can definitely see Draghi certainly at around 8:30 didn't help the markets. When you think about the different economic releases that were surrounding Mario Draghi, let's go back up here. Philly Fed certainly didn't help the markets either, but I think a lot of the sell-off that we saw was from number one, the initial reaction to Mario Draghi not cutting rates. There was actually a bit of a euro rally on the fact that he did not cut rates. And then he didn't sound nearly as dovish throughout the presser. And certainly, I think equities markets didn't like it one bit. So I look at the Dow, I take a look at even to a more minor extent, something like the DAX. Not a lot of equities markets liked what he had to say. So if we add this Google, this tech sell-off, we'll see how this opens at 9:30 tomorrow. But I start looking at the way in which the market digested the ECB. Yeah, so we'll definitely see both these things kind of come to a head tomorrow in the morning. So what do I want to do with this? I want to get opportunistic because the euro is actually still doing all right in terms of the overall trend. This is going to be ultimately a buy zone that we've corrected into. And why do I like this? Now, some of you have seen me use this heat map before. So if I'm going to give you an overall take of, hey, let's not worry that Mario Draghi wasn't that accommodative. He hasn't really been so probably since fall of last year. When I look at this heat map here, let me give you a watch list. And this watch list is going to extend past the currency markets and into any market that would benefit from risk appetite. So where can I buy euro? Before anybody out there is going to rush into any kind of euro buy, where can I buy euro? Specifically against two names, the US dollar and the pound. Notice the euro is only stronger than the US dollar and the pound right now. One of the worst ways you can wander into taking advantage of these central bank themes is by just buying euro against anything indiscriminately. Notice that very clearly, the Canadian dollar, New Zealand dollar, Australian dollar, and the yen are all stronger than the euro. So why would I want to buy something against another currency? Why would I want to buy the euro specifically against another currency that's doing better than it? So the watch list for a euro buy, because of that, is pretty short. Buy euro against US, buy euro against British pound. So if you're thinking about an FXE buy, that's fine. FXE, again, if you're not necessarily looking at euro US on the spot side, if you're not looking at euro US on the future side, here's the ETF. That means I'm still a dollar bear. That means for those of you that have been wanting to short dollars, who's been looking at dollar shorts over the past few months? Definitely from February and March on, but who's been looking at shorting the greenback? If you have been looking at that, remember, as long as you're a euro bull, it's okay to be a US dollar bear. And let me show you the supporting evidence for why I feel pretty confident about being a seller in the dollar. I prefer to go the DX route, but remember, you can play euro US, you can play dollar index, you can play UUP. So what's the supporting evidence? So before I give you the trade, Mahal, I'll be happy to give it to you. Let me show you why. Because if you don't understand the three charts that I'm going to show you now as kind of touchstones, as kind of confirmation to why you want to, number one, either buy euro US, or number two, sell US dollars, but overall pretty much believe that while we might have a hawkish Fed, they're probably not going to do anything. I'm going to take you to, first of all, the Fed funds futures for June. We're going to take a look at the contract for September and then also for December. Who's ever looked at Fed fund futures before? Fed fund futures. Fed fund futures? Yeah. Who's ever looked at those before? I don't trade these very often, but I'm going to tell you, when I see an upward angle on Fed funds, When I see movement above 99.50, so I'm going to show you some. So you don't have to trade them. Sunshine, you don't have to trade them, but you want to know, I believe, a great way to understand what our FOMC is going to do with rates. This is a great place to look at. So if you want to jot this down, we're looking at FFM, FFU, and FFZ for 2016. So here's how Fed Fund futures arithmetic, Fed Fund math goes. It's really simple. I think a lot of people look at these charts and don't quite know what they're looking at. So a 0% rate would be a 100 reading, essentially. I'm just kind of going to use the 25 basis points that we typically move in. So 100 even, 100.00 would equal 0%, a 0% Fed funds rate. So the way you determine what the Fed funds rate are telling you about where we're going to be in June would be, we take 100, we subtract the current price, 99.60. Now, if you do that, you end up with what? Now, this isn't a real rate, right? But you end up with 0.40, and that would be the percentage. Now, we're right around 0.5% right now. So, in fact, for June, we're not even holding steady at that 0.5%. Fed Fund futures are saying, you know, Janet Yellen probably was dovish, and we're certainly not baking into the cake any kind of rate hike. What does that mean? If I don't have a rate hike, why on earth would I catch much of a bid on the US dollar? If that bid is based on the dollar strengthening because the Fed's going to increase rates. Now remember, an increase in rates means what? We're going to see typically a stronger currency. Doesn't matter the country. Partly, that's why the euro strengthened today. No rate cut, and traders who are expecting lower rates after the minimum bid rate result, we didn't see it. Euro rallied on that. So same thing wherever you are. So FFM is showing that the Fed's going to remain pretty dovish for June. But I think we all knew that the Fed probably wouldn't move in April or May or in June. So let's jump out to September. And I'm looking at these quarterly contracts. We jump out to September, and we're sitting at roughly 99.50. So September is saying, hey, once we get to this, once we get to the expiration for Fed Fund futures in September, we're still not seeing a hike. In fact, let's go out to December. Same story. We're barely below 99.50. So is this by any means emphasizing that as we go later on into the year, that we're going to see a hike and the kind of sentiment that would tell traders, let's not sell dollars. We have a hawkish Fed. No way. But what I will tell you is be very selective about where you're going to sell the dollar. Sandy, to your question about the Aussie earlier, I think a lot of traders who don't look at cross rates or minors typically just look at whatever the currency is, euro, Canadian dollar, New Zealand dollar, Australian dollar, Japanese yen, whatever it is, against the US. But what I'm trying to show you here is you have so much more choice. So by choice, I mean, I don't have to buy the Aussie against the US dollar. Although right now, because I do feel the US dollar is going to continue to weaken for all the reasons that I just showed you on those Fed Fund contracts and for the overall uptrend that we have in the Dow. Today was a down day. That's fine. But if I step out to the longer term time frame, what are the three charts I want you to look at to understand what the ECB is doing? I want you to take a look at the US dollar. I want you to take a look at those quarterly contracts in the Fed Fund futures. And actually, I would rather you take a look at the Euro US than even the dollar index. And here's why. The Euro US is almost a perfectly inverse look at what's happening in the dollar, because a dollar index futures contract is 57.6% euro. In other words, dollar index is mostly euro with just a little fairy dust sprinkling of some other currencies for some window dressing. That's it. So if I think we can break higher through the 114 handle, which right now eludes us, this move down to 113, this move down to 1280, even 1255, I think it's a valid buy zone. So, Mahale, you're asking me what my buy zone is? I'm looking to jump in on this trade for a second time. I'm looking to do it one more time. But really, the gem of this trade would be to continue higher through 114. And that's where I realize that we're going to have to run the stops that are waiting through 94. And why do I feel confident about that? You circle back to the fact that Mario Draghi was maybe cautious but not dovish, and that there's no reason really when I look at Fed Fund futures or the Dow to consider the Fed's going to hike anytime soon. So I think, so Thomas, your question as far as if rates stay low, why are bonds moving lower? I'll tell you what, Thomas, last year I think the bonds kind of threw us off the scent. I've found that the more, and again, this is just looking at it from the standpoint of not only wanting to be a US dollar seller, but a euro buyer. I think the bonds threw us off the scent last year too. I think a lot of bond movement got the traders all amped up for maybe a June hike, a September hike, a November hike. And in reality, the only time Fed Fund futures budged to show us that there was a better than 80 or 90% chance of a rate hike was in December. So I look at the Fed Fund futures for being a lot less twitchy and a market that singularly looks at what is the Fed going to do. So bonds have to actually factor in. In my view of what happens globally, bonds have to factor in a lot of other, for example, the Chinese outflows last year. Let's talk about China for a moment and the BOJ. It's a great segue to that. So when China had to raise funds, and in this case, US dollars, right, after they devalued the yuan in August, they did what? They actually had to sell a lot of 5-year. And I know some of you play the 5-year and watch it as well. They had to sell a bunch of 5-year. That's how they raise capital. So those kind of moves in other countries, I think, are partly why we've got thrown off the scent in terms of what the real trajectory was for the eventual rate hikes. So I like watching the bonds, but right now I'm not finding a lot of clarity in that narrative. Where I'm finding clarity in the narrative is the trio of, you can look at the Euro US dollar or dollar index. It's pretty much 6 of one, half dozen the other. You can take a look at the uptrend in the Dow, and you can take a look at the Fed Fund futures. So I'm not saying take your eye off the bonds, Thomas, but I haven't found, especially last year, I didn't find that got me to where I wanted in terms of clarity and that rate hike narrative. All right. Now, if I feel that globally the equities markets are getting better, where I'm going to start are the two that got right hooked, right? I look at the DAX and I look at FXI. When I look at DAX and FXI, this kind of goes back to that same downward spiral that we saw from the yuan devaluation in August, and that very tight trading relationship between German exports, the impact on their GDP, and China. And we saw the FXI taken on the chin, and then in turn we saw the DAX head down with it. But what's happened since March? I've been long for small windows of time. I've been long FXI, long EWG. And one of the reasons the global economic markets have been kind of very hesitatingly bullish is because of this story. So we've got to talk about the BOJ here. So the yen story in no way is reflecting how much risk appetite we have right now. And I think this has been a major point of confusion and contention for a lot of traders who look at currencies and say, oh, I'm not getting the confirmation I need. And sadly, they abandon the currency story. So I know a lot of traders will look at the yen and then they'll go play their stocks. So look at the yen, they'll go play their stock index futures. And what I'm going to tell you is one of the best ways to do it is let go of the yen. I know it's a story, it's grabbing headlines, but it's not in sync with what's going on everywhere else. The yen is kind of doing its own thing. When a market loses harmony and sync with everything else, your best bet is to not force a trade there because there's a completely different narrative happening. The yen would actually the strength of the yen would imply a huge flight to safety. And yet you look at commodities, you look at the equities markets. Again, I took two of the most beleaguered index we could look at last year, Chinese large caps and the German DAX. And even those are looking better. And yet the yen would suggest that none of that should be believed. And in the meanwhile, we continue to march higher. So I would be leaving money on the table if I were not able to compartmentalize, put the yen on the side and say, where am I finding evidence of risk appetite? So back to the Australian dollar, back to the Canadian dollar, and even now, most recently, with a pretty darn good global dairy auction behind it, we can even look at the New Zealand dollar. So sometimes we have to look for evidence in other places. And this comes right back to the central bank. So right now, I would tell you all that are thinking about being aggressive and buying yen, heads up. And I want to show you a graph here of the yen and the impact of interventions. So this is a dollar yen chart, but as you can see, it's yen per dollar, so it's an inverted scale. Typically, this would be more akin to looking at dollar yen on the spot, not JY futures. Okay. So look what happens every time they intervene. Every time the BOJ tries to weaken the yen, they're an export reliant country. Every time they want to weaken the yen, it's for naught. The yen's going to typically do what the risk environment is suggesting it should. Right now, it's not. And I think that's where there's a huge disconnect. And that's why you have to abandon those yen trades, let those go, realize the BOJ is going to intervene. And if that happens, don't worry about the yen, although we'll have a tremendous sell-off in the yen. Don't worry about the yen. Look for where all that cheap money is going to flow. Look back to the Dow, look back to the S&P, look back to the NAS, the DAX, Chinese large caps. You can look at the FTSE. Go back to those markets where that cheap money is going to flow. No different than when the ECB floods the market with cheap money. And again, it's going to be no different than when the Bank of Japan hits the sell trillions of yen button. So I think too many traders are fixated on how they can take advantage of yen, and they're not looking for the move maybe one or two moves away. In other words, what do I do with all this cheap yen? What is the market going to do? If overall there's risk appetite, overall there's not fear in the global economic environment, which I don't see right now, they're going to want to go look for return. And that's where it's going to hit, I believe, markets like the Dow, Comdols. The carry isn't quite there yet, but that's another one to keep an eye on. The carry trade is not clear yet. Again, another place where the yen is really screwing up traders. So if there's a market that's not responding, it's not with the program, leave it alone. Bank of Japan will try to weaken the yen, but I think it's going to be for naught. So look for that yen intervention to help the places that are already showing you a clear trend. Okay, so let's see, a couple questions here. Jim asks, hey Jim, so Jim from my SFX room is asking, is this how you predict the Dow? Dollar goes up, Dow goes up. Jim, no, normally, no. I will tell you, how do I, well, number one, I don't predict, I follow. So my crystal ball's been in the shop for 25 years. I don't predict anything, but what I will say is, if the market's doing something, it's like an elephant on the beach. Those footprints in the sand, good luck hiding those. What I have here is a lot of green grab candles, a 12 to 2 o'clock angle, higher highs, higher lows, everything that I would want to see for a healthy uptrend. So now is no time to get contrarian. This is a pullback here. That's it. What's the difference between a reversal and a retracement? For me, 17,300. That's the difference. What's the difference between a reversal and a retracement? We're going to retrace, I think, clear down. We could retrace clear down to 17.3 and still maintain a bullish bias. South of 17.3, it may be a different story. Now, why is the market moving up higher, Jim? The why matters here. The why matters because despite the fact that the yen is strong, and it might be spooking a lot of equities buyers away, which would be a shame because the risk-on approach that we've been using here in the room has us long Aussie, has us long Canadian dollar. We're looking for getting long New Zealand dollar. It's been very profitable as we are shorting US dollars. So if you let this one lone distracting currency in the yen keep you from that trade, yeah, that's a shame. And I think that's what's happening. So dollar index and the Dow preferably should be going in opposite directions. So if I have an overall uptrend in the Dow, and it's because of the fact that we don't believe Yellen and company are going to hike rates anytime soon or even in 2016 at all, I'm kind of the side of we're not going to see higher rates. And if we're going to see anything, it's going to be a replay of 2015 where they kick the can, kick the can, kick the can. And then in December, just to save face, they'll throw us another 25 basis points. So I think continuing to look for opportunities long in the Dow makes sense. You add the Bank of Japan to that, more cheap money makes more sense. Now, how long will we struggle with this 94 handle? That remains to be seen. I don't actually need the US dollar to continue to punch down to lower lows, because if we can focus on other stronger individual currencies stronger than the US dollar, like the Canadian dollar, the New Zealand dollar, and the Australian dollar, we're in good shape. Okay? So just remember, yen intervention has not been a game changer, not by any stretch. And if we want to play the euro, what we want to do is remember that if Mario Draghi remains accommodative, he doesn't have to be dovish, but he just basically said low rates for longer. I mean, that's pretty much what Fed fund futures are telling us too. So we'll continue to take advantage of that. So in terms of predicting the Dow, Jim, we're just going to continue to look for buys on those corrections, those retracements, and we'll continue to watch it. Now today, for example, we were short the Dow. I could look for a longer term Dow trend follow while day trading the Dow lower. Today was a pure trend follow with plenty of opportunities to re-enter throughout the day. This was a pure clearing range. Well, it wasn't even a clearing range breakdown. We had a trend on the euro. We had a trend after the euro. Mario Draghi didn't do anything. Like I said, no rate cut, and he wasn't actually indicating that he was going to be looking at any kind of rate cuts. So I think the euro strengthened, and ultimately we see more Dow weakness. So look for an inverse relationship in some ways to the Dow and the euro. I think that's partly what we saw here today. Now that's what, ask about how we can, I don't want to use the word predict, but let me just borrow that for a moment. Yeah, if I want to predict what the Dow is going to do, Mario Draghi set the tone. There's no reason for us to look at that. So Mikhail, yeah, Mihail, I'm looking at Euro US. Euro pound is trickier. Euro pound is going to be much trickier. So that brings us to the Brexit conversation. So this brings us to the Brexit conversation in terms of euro pound. And, I was having a conversation about Brexit. Was I talking to you about Brexit? Is that bad news or good news? Oh, yeah. So the other day, there was a 200-page document that was released, and it outlined all the things that are likely to happen if the UK leaves the European Union. By the way, how many of you have been looking at the pound weakness? I know that's not necessarily something that would be a logical extension of a lot of equities traders, but FXB is the currency share ETF. You could look at BP futures. You could look at Euro US as well. I'm sorry, Pound US as well. So if you're taking a look at what's been happening in the Brexit conversation, the fear of the unknown, which is always one of those fears that's going to keep traders running for the hills, the fear of the unknowns kept a lot of selling pressure on the pound, not necessarily or the most clearly against the US dollar. Go back to, can I find a weak story and sell it against something much stronger? Well, everything is stronger than the pound. So while I said if we're looking at risk appetite, uptrend in the Dow, uptrend in the S&P, NASDAQ, DAX, Chinese large caps, the Australian market's been on fire. Look at global equities markets, all heading higher. One of the best clear individual currency stories has been, let's buy COM dolls. The yen weakness has not appeared. So buying COM dolls, Australian dollar, Canadian dollar, New Zealand dollar against the pound is your best bet. Your next best bet, kind of a Not a great bet, but that's the euro. Why has the euro been a good buy? Well, on one hand, the European economy is doing better. The German equities markets are doing better. And the US dollar has been moving lower, which also props the euro up. So when I look at euro pound, we did actually buy euro pound, but we're actually looking for a catalyst to get it out of the hole here. You can see we pulled back, and I think we're supported. But before the bullish momentum comes, we have to get the support. And that's what we're looking at right now, the support here. So how do I handle Brexit at this point? When I was first thinking about this talk for you guys, Brexit was basically echoing of what we had seen years ago, the volatility of Grexit. Who remembers Grexit? Right, the Grexit volatility? This right here, this takes us back to 2011. This was some of the initial chop that we saw in the Dow because of the potential for a Greek exit. Well, a UK exit, I think, would be hugely impactful economically, not necessarily for Europe, but more so for the UK, which is why we've seen so much British pound weakness. So the impact is certainly something that I think a lot of traders are maybe not considering, because it's not something like Grexit that's being brought to the forefront via the media every single day. Remember during Grexit, every day, CNBC, 24/7, it seemed something new, some new storyline, some new plot about the Grexit situation and the ECB. But we're not seeing the same thing with Brexit, the British exit, potentially. If that vote on June 23 was a yes vote, well, I don't know if it's a yes to leave or yes to stay, but let's just call it if they exit the European Union, I do believe we see the same kind of volatility and fear hit the equities markets. But this kind of goes back to this conversation I was having with my friend, and she said, well, why would you call that news bad? So, well, what do you mean? She goes, that 200-page document you're calling bad. Why is it bad? And she was right, because the longer I thought about it, the more bad news that was coming out about the potential for leaving increases the likelihood that we're going to stay. The more that we paint a very vivid picture of how bad a British exit could possibly be, the more likely voters in the UK are going to go to the polls on June 23 and vote to stay. Because why? Well, the devil we know is better than the devil we don't. And until a much clearer picture is painted, if it is at all, about how good things could be after they leave, and I don't think that's been something we've seen at all. In fact, the polls in the UK show a 49% vote for yes, let's stay, and a 39% vote for let's go. Now, there's some interesting things about this polling data. We'll see how this pans out, but they do say that the go vote would be more likely to show up in the polls. That 10% difference probably isn't that wide a chasm, but I think we're seeing definitely a little bit more leaning towards staying in the EU. Well, status quo would be great. It's no reason then for the pound to continue to sell off, and there's little reason for global equities markets to move lower on the uncertainty of that kind of event. So I think that Brexit conversation, as you mentioned, Mihail, about the euro pound, this is where that pound short against the euro gets very iffy. So I'm going to tell you, those of you that are looking at euro pound, think about if that trade is driven by your desire to sell pound, look elsewhere. Where? Pound Aussie, pound Canadian dollar, pound New Zealand dollar. If your desire is to buy euro, this is the second, in a distant second choice, your euro US is going to be far superior. You know, just in about 4 or 5 days, we've taken bounces from 113 and 112.5, rode them up to 113.5, rode them up to about the 114 handle for nice profits, just in that little bit of movement there in front of the ECB. I think this is far more predictable movement, so focus on that euro US. All right, so I mentioned that we would talk about some implications for the open from Google. So the first thing that pops into my mind is, what's Google going to do? And I'm not even concerned about what it's going to do to the yen, quite frankly, but what's Google going to do to the overall risk environment? You know, how much of a sell-off in the NAS is going to start to affect Let's go to the NAS and let's see. Non says the NQ is getting smashed. So how much of that is going to start to spill over into the S&P, which is relatively tech heavy, and then with a lot of overlap from some of the major holdings, and then eventually spill over into the Dow. So when I look at the NQ, obviously moving lower, remember about 9.5% of the weighting of the NAS is Google. So I've got Alphabet. I got this bugs Alphabet. So I've got Goog and then Google, right? So accounts for about 9.5%. Now, what I'm really going to do tomorrow, and this goes back to again all that interwoven weighting in terms of this index. I'm going to look at what Apple is going to do. Is Apple selling off sympathetically? What's Microsoft going to do? Because between those two names, I'm at about 20% of the NASDAQ in terms of percentage of assets, right? So what is Apple doing? What is Microsoft doing? You throw Amazon in there, and you add another 5.5%. So now I'm at about 25% of the NASDAQ with just those three names. You throw Facebook into the mix as well, you tack on another 5%. Now we're talking about 30%. Right? So if I see Apple, Microsoft, Amazon, Facebook, about 30%, if I see those names recovering, I know that 9.5% of Google dragging it lower may not have the same impact, and we could fade that gap down if we even get one. We'll keep an eye on the NQ. And then I know if I start to get that fade, I'm not going to be as concerned about that spillover into the S&P and then eventually into the Dow. So the NASDAQ and the S&P have that very heavy tech overlap, and then my S&P and my Dow correlate about 80+%. So even though I don't have that much exposure to tech in the Dow, I have some. It's limited. I know that with the sympathetic movement with the S&P, again, it's kind of spilling from one bucket to the next. So I'm not going to draw a straight line from the NAS to the Dow, but I'm going to watch the way it moves from NAS to SPOOs, then maybe over to the Dow. And then I'll get a better idea of my overall risk environment and whether I could see a sell-off in. Forget the yen. That's our mantra here today. Forget the yen. If the BOJ does intervene, we'll find the opportunities likely to buy yen into that weakness. But in the meanwhile, I want to look to see what it does to my Australian dollar, my Canadian dollar, my New Zealand dollar, and also possibly the euro loves risk appetite. We'll take a look at the euro as well. And one of the things, again, look for the inverse relationship between the Dow and the US dollar. Okay. As far as the toss symbol, Jeannie, for the Fed Fund futures, I know that the CME uses FF, and I'm using the M, the U, and the Z contract for December, September, and December. Okay, so that's the way I'm going to look at how we're going to open in the morning. Don't look at the yen. Don't look at Aussie yen. You can keep it on euro dollar, and you can keep it on the Dow as well. But let's take a look at some of those components, those heavier weighted components within the NAS. Patricia, can I comment on US dollar, Swiss franc? So as far as the franc goes, the Swissy, I'm not a big fan of the franc. And let me tell you why before I tell you don't consider it. But the franc is a currency that's affected by a very secretive central bank. We don't hear much about the SNB until they want to do something dramatic, and then we get zero warning. So one of the reasons I think a lot of people are looking at franc is because they're looking still at the euro franc. But now that the SNB ditched the peg, I'm not that big a fan of looking at euro franc. Because again, if I'm looking at the euro, the inverse relationship back to the dollar is huge. The most traded pair in the spot market is the euro US. So I know a lot of traders still look at euro versus franc for clarity, and then we would then take that to the dollar versus the franc. On the weekly, it's choppy. On the daily, it's probably a downtrend that's recently reversed, at least transitioned. So I would tell you what I lack here is longer term clarity. And if I don't have longer term clarity in a daily or a weekly chart, what I want to do is avoid that individual currency story altogether. So Patricia, I would say my question for you is, what do you want to do with the franc? What I want to do with the franc? Is your desire to play dollar franc? So you're long. Okay, well, if you're long, and I'm not sure where you're long from and what time frame. And Patricia, feel free to drop me an email if you'd like. Oh, sorry, you're short. Well, let me give you both sides. Let's talk about both sides. If you're long, it's because you faded the weekly range at the bottom. Okay, that's valid. Okay, if you faded something like a 95 or a 94.80, that's fine. If you're short, it's another fade. You're looking at a fade if you're short. So let me give you a little insight into where I think the selling pressure could come in. And gang, this is something we do every day in the SFX room, which is we just dial it back down in the most simplest sense. What are the market trends? So the easiest thing to do in any market is understand what the underlying psychology is. Even before you start overlaying intra-market relationships and economic data and all that other stuff, Patricia, I'd look for 97.50 to 97.80. Okay? In terms of where we might exhaust, throw a slow stochastic. I like a 21 period and look at the daily to exhaust in this area. These are breadcrumbs. We've done it before. Okay? All right, let's see. Ted asks, and gang, I'm going to catch up with some of this Q&A, so keep it coming. So Ted asks, I had to stop 5 points below the NQ entry, and it didn't fill when Google caused a drop. But that loss could have run to infinity. Does this happen often? CME wasn't very clear. So NQ, okay, so let's jump over to the NQ. So we're talking about NASDAQ futures. NASDAQ futures. So first of all, we moved. Take a look at the NQ. I'm going to tell you the move that we had down to 4,500 on the NQ is actually, so I got to backtrack just a bit, just a little bit. I want you guys to think about, are you pre-positioned in front of an economic release, or are you waiting for what I call a catch the wick opportunity? If you're looking for a catch the wick opportunity, 4505. So this goes back to the NQ question. Ted, your question. To me, 4505 down to about 4490 is my aggressive zone. The remainder of my position would be built around the 4460 to 4470 area. So I'm looking at a 20-period simple moving average, and I'm looking at a 34 EMA on the high. This is pure and simple 100-year-old theory, market trend analysis with the benefit of some computer-aided indicators, right? You take 100-year-old theory, Charles Dow, Richard Wyckoff, talking about market trends and phases and the psychology that they reflect. I put a few moving averages, color code some candles, and then I've got the modern day interpretation of what market trends mean. If I've got an uptrend, kind of harkening back to what we talked about before, retracement versus reversal. I don't have a reversal here till we get south of that 200-period simple moving average. So to answer your question about getting flattened for a loss, let me tackle the first part of your question. What was the trigger for your buy? Catch the wick means you've parked an order, and I would look at limit orders to buy between 4505 and 4490. Now, depending upon the time frame you're looking at, your validity for the trade could be very different. If you're trading a 5 or 15-minute time frame, very different conversation than my setting up a trade on the daily, right? So could it run to infinity? Does it happen very often? Ted, I mean, in terms of the volatility of something like Google, so think about the impact Google has on the NAS. Could it have been a much larger loss? Absolutely, my friend. What I'm going to tell you is use major psychological levels to your advantage. What you had as we headed down lower was the 4500. Now, I'll typically look for about a 5-point diameter, if you will, above and below that level. We actually hit 4480. So you have to look at what the limits are for NQ. I don't know them off the top of my head. I'm more of a Dow trader, but if you want to know, Ted, shoot me an email and I'll be happy to let you know what those levels are. But technically, I mean, in terms of the losses, talking about going to infinity, well, that all depends on your execution, right? Your liquidity. There's a lot of other factors in there. But what I want you to think about for a moment is the actual entry and the reasoning for your entry and whether or not you were respecting the overall trend. The sell-off for me as a trend follower is not the trade. Where the sell-off took me to support is very much the trade. And I would not be surprised one bit if Apple, Microsoft, Amazon, and Facebook help me out a little bit, that we completely shrug off what happened in Google. Despite the fact that that's 9.5% of the NAS, I wouldn't be surprised at all. All right, but I'll see you guys in the chat room tomorrow, and we can definitely talk more about that then, 100%. Warren asks, sorry for the simple question. No bad question at all. So the question is, could I explain the colors of the candles and the grab concept? Absolutely. So before grab, this was me, although I'm not a dude. You're kind of guessing at what a move means, right? You're guessing at whether or not you're looking at strength. You're guessing at whether or not you're looking at weakness. And even worse, you're guessing at what the reaction is going to be at decision levels, which we more commonly call support and resistance. If I draw any trend line on a chart, it's because I think something's going to happen there. What I think is going to happen is going to be predicated on the market trend. So here's the simple of it. I look at green grab candles and an angle that moves what I call higher to 12 to 2 to reflect an uptrend or markup, as Charles Dow would call it. And I look at red grab candles and what I call a 4 to 6 o'clock angle to represent a downtrend or a mark down. The red candles, whether they be the dark red or the light red, reflect bearish sentiment and momentum. Okay? And the angle is the culmination of that sentiment and momentum eventually organizing into a trend. Warren, if you head on over to, and let me give you a link, this will be really helpful for you. If you head on over to my site, simplerforex.com, I've got the indicator number 1 and an entire series on how to use it. Here, let me push it through. This is the essential downloads getting started link that I just gave you. If anybody who wants it, this is the link. And there's a webinar on the grab, and there's an explanation on the grab, and also how you can install it on the TOS program, TradeStation, and also MT4. And then how to use it. So there's a webinar there as well. And I think that's going to help you out a ton as far as market trend analysis. And I'm going to tell you right now, market trend analysis is how I trade corn, cocoa, Cisco, Canadian dollar. Doesn't matter. Okay? All right, so you guys got the Fed Fund futures there, Jeannie? Okay, very cool. All right, so we got about 5 more minutes here, gang, and we'll wrap it up. And let me take a look at some of the other questions we have here. So I really hope that as we've kind of walked through the markets here, realize, yeah, a lot of my conversations, being predominantly a currency trader, are going to start with, say, dollar or euro or some of these other currencies. But notice, and I want to show you something here on my quote board. The first third, actually almost half of my quote board, is what I endearingly call the 4 extra. So before I started trading the spot currency market, otherwise known as the Forex, in late 99, early 2000, I spent most of my time as a junior and senior in high school, and then throughout college, trading commodities. And the reason I liked commodities, and I loved markets like coffee, cocoa, cotton. I loved the softs. Loved them. Why? Because they offered me a ton of leverage. I loved the leverage. And then when I realized, hey, here's the Forex market, and I've got 400 to 1. You guys remember back in what they call the Wild Wild West days of 400 to 1 leverage? So that definitely became, oh, wow, this is like coffee and cotton and cocoa exponential. I had so much more leverage. Well, so my first love were commodities. And luckily, when I went from a lot of that commodities trading to trading currencies, I didn't supplant it with currencies. I supplemented it. In other words, I carried along with me all that I learned about commodities into the currency market. And I'm glad I did, because I think it gives me a huge advantage. For those of you that are currently looking at different equities markets and looking at the way in which different equities markets reflect the overall risk environment, if you carry that over to currencies, you're going to find a wonderful intermingling and a great way to confirm your trades, both ways, for currencies and for your equity. So notice a lot of what I do is first starting off understanding what some of these key markets are, because what is the Nikkei going to tell me about the yen? What is the Dow going to tell me about the yen? Notes, crude oil. I can't trade the Canadian dollar without understanding crude. Gold. Gold, I'm going to tell you, Sandy, to your question earlier, my main trade on gold has been buying calls on pullbacks to 1220 to 1205. Copper, if you're looking at the Australian market, I will recommend take a look at the iron ore market, take a look at copper, and take a look at crude. Copper and crude, for those of you that attended my December Outlook on 2016, I think you can still find that replay at the site. Copper and crude are what I call my two canary in a coal mine. In other words, if we're really seeing a recovery, I'm going to see it in copper, I'm going to see it in crude. If I want to understand where the Australian dollar is going, I got to look at iron ore. And I also got to keep an eye on aluminum exports out of China. That's been an interesting one too. And how does that help? So please don't minimize the Aussie just to gold. Even though they're the third largest miner of gold in the world, iron ore is a hugie for them. All right. So let's see. Do I have to be a member of Simpler Forex to get the grab info? Donald, no, not at all. Not at all. There's a lot of free info you can get over at simplerforex.com. The essential downloads is just one of them. You can check out the blog. Absolutely. Or you can get on the email list, and I can send a lot of that stuff your way. Yeah, if you head on to the homepage, simplerforex.com, and scroll down to, let's see, I know there's a place you can, I think at the homepage you can sign up for the free newsletter, and I send out a lot of this analysis through some of the videos there. Okay. The link I shared, yeah, if you have any questions about the download, Kevin, just let me know. You can send it to Raghi at simplertrading.com. Yeah, if there's any tech issues with that, let me know. I'm not aware of any. And you can also get the plugin from the TradeStation site, and I could send you a link, so no problem with that at all. Okay, so gang, I think, oh, you're welcome, of course. What other questions we have here as we wind down? So by the way, thank you so much for hanging out for this last hour. We've talked about the Brexit and how much it's going to echo of our Grexit conversation. BOJ, leave the yen alone until we see intervention. Don't use the yen as some sort of barometer to the risk environment. Use other currencies, Aussie, Canadian dollar, New Zealand dollar. I showed you how much of an impact some of these central banks can have from, we talked about the yuan devaluation. Of course, we saw it on the equities markets, but we saw it on corn. We saw it on Facebook. Heck, I could show it to you on Netflix as well. All right, so got to keep an eye on those central bank themes. In fact, one of the calendars that I would recommend you use, even as an equities trader, maybe especially as an equities trader, is the calendar over at Forex Factory. If you liked this heat map that I showed you to understand the relationship between the different currencies, this is available at simplerforex.com/heatmap. simplerforex.com/heatmap. All right, so I will see you all actually in the chat room tomorrow. So let's see, as far as stops, yeah, some of these questions, yeah, bring them to me tomorrow for our 1 o'clock breakout session. By the way, Monday, Wednesday, Friday, we talk about some of these setups in the chat room. So bring some of those questions tomorrow. We can pick up the convo there. And in the meanwhile, yeah, if you guys want to check out the grab and the wave, put them on your charts. It'll just make our conversation easier in terms of that market trend analysis that I use in every market. TO, I believe, TIO, Sandy, is a symbol for iron ore. Laurel, is this recorded? I think so. It should be recorded. I do have it as well. Yeah, I'll send it out with my email. So if you're not already on the email list, head on over to simplerforex.com and I'll send it out, or it'll be available in the chat replay here at Simpler Options. Okay? Jeannie, my pleasure. My pleasure. Absolutely. Diana, I'll take a look at that. China seeks to establish its own gold benchmark. I will check that out. Yeah, I'll check that out. All right, thank you again, gang. Actually, Matt asks, I'm new to Forex. What would be my recommendation to start and reading material? Matt, I'll tell you, check out the blog. Make sure you come hang out with me here in the room Monday, Wednesday, Friday. And get on the email list, Matt, because I send all sorts of currency trading and a lot of the other topics we talked about here. A lot of that goodness. So yeah, head on over to Simpler Forex, get on that email list. And if you have any other questions, just shoot me an email, Raghi@simplertrading.com. I'll make sure you get off on the right foot. Candace says, thanks for this unexpected treat. Great, my pleasure. Please, my pleasure. Thanks to the SO guys for letting me squat in the room here for the last hour. Loved it. I read, let's see. Laurel, you read A Secret Meeting in China? You know, it's great. Everything's on the price charts. That's why I trust the market trends so much. It's hard to hide anything in price. All right, gang. Have a great one.